As of right now, Friday, March 6, 2026, the SoFi Technologies stock, trading under the ticker SOFI on the NASDAQ, is currently priced at $19.12 per share, marking an intraday increase of 2.26% during the early hours of this Friday session. This movement follows a period of intense volatility that has seen the stock retreat nearly 40% from its November highs, yet the current green on the screen suggests a decoupling from the broader fintech sell-off we witnessed throughout February. While many retail investors were bracing for another leg down toward the single digits, the reality of the last 48 hours has provided a massive shock to the system. The expectation was that institutional outflow would continue as the market digested a massive equity raise and insider selling reports. However, the reality is that the CEO just dropped $1 million personal buy into the market, and a massive partnership with Mastercard for stablecoin settlement has turned the technical narrative on its head. This divergence between the public narrative of a struggling fintech and the internal confidence shown by leadership is where the real story of SoFi stock lives today. If you've been looking for investment help or scouring investing sites for a reason why a company with a record-breaking billion-dollar revenue quarter would still be trading at a discount, you are not alone. The common ground most investors share right now is the belief that SoFi is caught in a valuation trap. The bears argue that at a price-to-earnings ratio still hovering in the premium range compared to traditional banks, it is simply too expensive. But when you challenge that belief with the growth metrics, the picture changes. We are talking about a company that added 1 million members in a single quarter. That is not a bank. That is a scaling technology platform. People often compare this to NVIDIA stock or Apple stock in terms of retail fervor, but the mechanics here are far more grounded in the shift of the individual brokerage. The recent stock movement has been a masterclass in market psychology. Throughout February, we saw a steady decline driven by fears of credit deterioration and the massive $3.2 billion equity raise that diluted existing holders by roughly 16%. This led to a massive spike in trading volume, often exceeding 80 million shares a session, as institutional activity shifted toward defensive positioning. But look at the intraday movement today. The volume is normalizing, and the price floor seems to have been established around the $17.50 to $18 range. When the market opened today, we saw an immediate bid that pushed the price above $19, likely fueled by the news of SoFi being the first U.S. chartered bank to offer direct on-chain Solana transfers. This is a move toward what the company calls a one-stop shop, and it's catching the eye of those who usually stick to the Robinhood app or SoFi Active Investing. If you look at the Robinhood stock trading trends or how people are utilizing SoFi Invest, you'll notice a trend where the younger demographic is moving their entire financial life into these digital hubs. The institutional activity we are seeing right now from firms like Bedell Frazier and SJS Investment Consulting shows that the big money is starting to accumulate on the dips. Even though we saw some insider selling from executives like Kelly Keough, the massive buy by Anthony Noto has acted as a psychological circuit breaker. It tells the market that the people running the show think the current price is a steal. This is why the SoFi trading platform is seeing such high engagement lately. The tension here is between the technicals, which show the stock still trading below its 200-day moving average, and the fundamentals, which are screaming record growth. For those of you watching this, I want to hear your take. Comment below how many shares of SoFi stock you currently hold, or if you are waiting for a deeper dip before you pull the trigger. When we break down what this company actually does, we have to move past the idea that it is just a student loan refinancing company. That was the old story. Today, SoFi Technologies operates through 3 distinct segments: lending, technology platform, and financial services. The lending segment is still the massive engine, producing $7.5 billion in personal loan originations in the last quarter alone. But the real hidden value that most people miss is the technology platform, driven by Galileo and Technisys. This is the infrastructure that powers other fintechs and international banks. It's essentially the back-end plumbing for the digital economy. When you use an online investment tool or a robo-advisor, there's a good chance you are interacting with technology that SoFi owns. This diversification is why they reached $1.03 billion in quarterly revenue, a 37% increase year over year. Looking at the older reports, we can see that the shift to a national bank charter in 2022 was the catalyst for the current business model. It allowed them to hold deposits and use that low-cost capital to fund their loans, rather than relying on expensive warehouse lines of credit. This is why their net interest margin remains so high, often above 5%, even when the Fed is playing with interest rates. The SoFi Robo-Advisor and Schwab Intelligent Portfolios are competing for the same slice of the pie, but SoFi has the advantage of the direct deposit anchor. Once a member sets up their direct deposit, they are 40% more likely to buy a second or third product, like a credit card or a mortgage. This is the cross-sell engine that is driving the 68% Rule of 40 score, a metric that combines growth and profitability in a way that very few companies in the S&P 500 can match. As we look toward the remainder of 2026, the future outlook depends on three major catalysts. First is the scaling of the SoFi USD stablecoin. By partnering with Mastercard, SoFi is essentially trying to bypass the traditional settlement times of the banking system. This is a massive play for fee-based revenue, which already surged to $443 million last quarter. Second is the interest rate environment. If the Fed begins a steady cutting cycle, the demand for student loan refinancing and mortgages, areas where SoFi has a massive brand presence, will likely explode. Third is the expansion of the technology platform into institutional clients. If Galileo can land a top 10 global bank as a client for its core banking software, the valuation multiple on this stock will have to be completely rewritten. However, we have to be real about the risks. The fintech sector is notoriously sensitive to macroeconomic pressure. If we see a spike in unemployment, the high FICO scores of SoFi's borrowers, averaging 746 for personal loans, might not be enough to prevent a rise in charge-offs. This is the reality that the bears are betting on. They believe the credit cycle is turning and that SoFi is over-leveraged. But with a debt-to-equity ratio of only 0.17 and a tangible book value that grew by over $4 billion in 2025, the balance sheet looks significantly more robust than the critics suggest. When you compare this to the volatility of something like Nvidia stock or the slower growth of Apple stock, SoFi offers a high-risk, high-reward profile that is unique in the financial sector. If you are using Fidelity investments, Fidelity ETFs, or even managing your own portfolio through interactive brokers trading, you know that the fintech space has been a battlefield. The competition from Fidelity Brokerage or Fidelity Wealth Management is real, as these legacy giants are finally updating their mobile apps and trading platforms to compete with the likes of Robinhood app and SoFi Invest. Yet SoFi's ability to integrate everything from a high-yield savings account to crypto trading remains its biggest competitive advantage. It's about the cost of acquisition. While other banks spend thousands to acquire a single customer, SoFi's ecosystem allows them to acquire a member once and sell to them forever. In summary, the expectation for SoFi was a period of stagnant growth following a dilutive capital raise. The reality we are seeing today, with a price of $19.12 and a positive intraday move, is that the company is outperforming its own guidance. We have seen record revenue, record member growth, and a CEO who is putting his own capital on the line. The contrast between the bearish market sentiment and the bullish operational results has created a gap that usually closes one of two ways. Either the growth slows down to match the price point, or the stock rallies to match the growth. Given the 30% revenue projected for 2026 and the expansion into the crypto ecosystem with Mastercard, the latter seems more likely. You have to decide if you are looking at a momentum trap or a generational entry point. As you look at your individual brokerage account today, whether it's through Fidelity IRAs, Fidelity mobile app, or even Robinhood Investments, remember that the most successful investors are the ones who can see past the daily noise of the ticker. The current market for SoFi is defined by high beta and high emotions, but the numbers, the $1.01 billion in revenue and 13.7 million members, don't have emotions. They represent a clear trajectory of a company that is no longer just trying to be a bank, but is successfully reinventing what a bank looks like in 2026. Whether you are into self-investing or you prefer the guidance of a SoFi robo-advisor, the data suggests that the expectation of failure for this fintech giant is increasingly becoming a ghost of the past. The insights we have covered today highlight a company that is successful